Hello, good afternoon once again, everyone. Thank you for taking time out and joining our Wealth Wisdom webinar. Hope I'm audible to everyone. And this is the series where we have started to, help investors in their investment journey. Our first session was on how you can diversify your investments through, various asset classes. This session, we would be focusing on mutual funds, particularly of what kinds of mutual funds are available in India, what is the structure, how you can invest into, what could be the do's and don'ts while investing into mutual funds. So that's precisely what you can expect from this session. So over to Andrew. He can, just brief us on what Network FP is doing into, helping investors with financial education. And our guest speaker for the day, Mr. Gajendra Kothari. So over to you, Andrew.
Thank you, Anjani. Good afternoon, team, and thank you so much for joining us for this afternoon session. So, about Network FP, Network FP is India's largest community and knowledge platform for all the personal finance professional, right? And we are published in listed qualified professionals who are committed to ethical practice and for the benefit of the people on. So we have our directory there, members.com, members.networkfp.com, and we are into a mission on educating people on personal finance, right? And we want to achieve a million participants who have attended. So that will be our vision and mission of this run. And about the speaker, so we have Mr. Gajendra Kotari, founder of Etika Wealth Private Limited. So he has around 19 years of experience in personal finance space, and he's a chartered financial analyst and chartered alternative investment analyst, MBA from IIM Delhi. And prior to heading Etika Wealth, he was the vice president and head of products for the portfolio management division at UTI Mutual Fund, and he was also the business development head for UK and European markets for UTI International Limited. He has conducted more than 200 plus financial awareness camps and workshops in the area of personal finance for approximate about 50,000 participants in 11 years. Right, Mr. Kotari has a vision to create 100 crores of wealth before the age of 50, thereby becoming the one idiot, right, to inspire others through his own story. So we present Mr. Kotari here for the session as a speaker. Over to you, sir.
Thank you. Thank you so much, Andrew, for that generous introduction. Good afternoon to all the participants who have joined in from different locations for this session. Thank you so much for taking out your time on a Saturday afternoon. Your time is very critical. This session might be free of cost to you, but your time is not free. So you'll have to pay attention to get something out of it, right? A big thanks and shout to MProfit. I think they are doing a fabulous job of kind of empowering their users, since they're anyway doing a good job in giving you a platform where you can track all your assets. One thing I've always believed in India, that most of the time we work hard for money, but somewhere our money is not working hard for us. And the reason why, because our assets are all scattered and we have never been able to get a bird's eye view कि हमारे पास कितना पैसा है, right? And thanks to, I think, MProfit software, which is one of its kind in the country, where you are able to track all your investments at one place and find out that are your investments really working hard for you or not. So fantastic. And now they are doing one step ahead of empowering you guys to take better investment decisions by such webinars through tie with Network FP. And as Andrew mentioned, Network FP, as a organization of personal financial professionals across India, they are doing a fabulous job in educating households on and improving their financial literacy, so that we as a country, I mean, when we're talking about independent Bharat and Atmanirbhar Bharat, the day we are all become financially independent, I think that will be a true victory, for our country as a nation. So with this, I would like to start today's session. As you would have known, the topic mutual funds, do's and don'ts. Now, mutual funds have become such a big thing, right? So So today it is important for all of us to know, and I'm sure almost all the people who are attending would have some sort of investments in the family doing in mutual funds. So this session is all about do's and don'ts and some basic stuff. The idea is first 45 minutes we'll try and complete my part of the talk, okay, and then we'll take as many Q&A. We want you to ask, we want to address a lot of questions and answers so that before you go back home, whatever queries you had, that should get resolved, right? And this 1 hour, the time you're spending should be really worth, for the weekend, right? So just one quick chat I want to have from all of you is, how long have you been investing your money in mutual funds? So you can type in the chat box, okay? Option 1, 2, 3, or 5, whatever you feel. So just type in the chat box so that I can get a sense of the people who are attending this, and I can calibrate my presentation accordingly. How long have you been investing your money in mutual funds? Type option number 1 if you've never invested. So most I can see it's 4, 5 options, most of them. Okay, some are 3 also. So I do not see 1 or 2 at all. In fact, which means it's a very evolved audience. Okay, mostly it is 4 to 5. So I now understand that that what I need to cover. So that, thank you so much for that feedback. Okay, fantastic. Okay, great. And do you think, my second poll is again very interesting, do you believe, because now that you've been investing for 4 years, 5 years, 6 years, 7 years, do you think mutual funds can help you meet all your savings and investment needs for an individual? Which means you don't need to go to any other choice, point of vehicle. Do you think this can help you achieve all your goals? Okay, so a lot of them are saying no, or option number 2, okay, and few of them are saying yes. So majority of the people are saying no. The answer is no, and few of them are saying yes. Okay, good. Good again, insight for me. Great. So again, since it is known, this is what people used to think about mutual funds. At least 7 years back, there was a finance interview in which Vishal was asked, Vishal, what do you know about mutual funds? After thinking for 5 minutes, he says, mutual fund investment are subject to market risk. Please read the offer document carefully before investing. So this is what people in India used to think 5, 7, 8 years back about mutual funds. 8, 9, 10 years back, people had lost a lot of money in 2007-8 crisis or 2000 crisis. And that is why anytime the word mutual fund used to come, they would think it's market risk. Any ad that would run on TV, and you see the last disclaimer running so fast, mutual fund investment are subject to market risk, so fast, people used to get worried कि अरे इसमें पैसा डाला मतलब रिस्क है, पैसा नीचे जाएगा, right? So this is what the trend was. But 5, 6 years back, huge campaign from the industry, from MP, started running, which says planning long term करनी हो या short term, थोड़ा थोड़ा करके भी इन्वेस्ट किया जा सकता है, सिर्फ 500 रुपए से शुरुआत करनी है, इमरजेंसी में पैसा निकालना है तो आसान है, राइट? मतलब म्यूचुअल फंड सही है. आपने ये सारे एड्स टीवी पे देखे हैं, you've seen these advertisements on newspapers, on the bus stands, billboards, all over, IPL, World Cup, etc, etc. Suddenly mutual fund are subject to market risk has now become mutual fund sahi hai, and that is why today we see 17,000 crore monthly SIP coming into mutual funds, and people have made wealth in the last 3, 4, 5 years, good returns. That's how. But again, many people somehow, even after they've been investing into mutual funds for last 3, 4 years, when I ask कि बोलता नहीं मुझे म्यूचुअल फंड में डालना, मुझे SIP करना है. You ask your family members or relatives, बोलता नहीं मैं पूछ रहा हूँ आपने म्यूचुअल फंड में पैसा डाला है, लोग बोलते नहीं मैंने म्यूचुअल फंड में डाला, मैंने SIP की है. So SIP has become an even bigger term than mutual funds. But just अगर आपको किसी को म्यूचुअल फंड समझाना है तो this is like this, So suppose you have to fly from Mumbai to Delhi or Bangalore. Can any one of us in this chat room, charter this aircraft on our own? कि पूरा plane charter किया and now we are going to Delhi or Bangalore. very unlikely. It would cost a lot of money to us, right? हर सबके पास इतना पैसा नहीं है, but हम सबको बॉम्बे से दिल्ली जाना है, तो हम क्या करेंगे? हम लोग सब 3-4 हज़ार रुपए का टिकट्स खरीदेंगे, okay? And we will go, we 300 people charter this aircraft cumulatively together. Can we still go to Delhi now? हमने सबने कर लिया है. Can we still go to Delhi? Do you think कि हमने प्लेन ले लिया है? The answer is no, because we need a pilot. हम लोग खुद से कोई चला नहीं सकते हैं, तो we need a pilot. We have to pay him or her a salary or wage. And now that the pilot is on board, we have flown to Delhi or Bangalore, wherever we want to go, and our objective is met. Our destination has come. Mutual fund is exactly like this, guys, right? हम सबके पास 1 लाख, 2 लाख, 5 लाख रुपए है, right? और हम खुद से इन्वेस्ट नहीं कर सकते हैं. I mean, I'm sure being MProfit investors, you are putting money in stocks, right? But not all of us can do. Not all of us have time and bandwidth to put it. Or so that's why we pool this money. किसी के पास 1 लाख है, किसी के पास 5 लाख है, किसी के पास 10 lakhs है. We pool this money, give it to a professional fund manager or a pilot, okay? And that fund manager invests in different kind of securities, right? That fund manager invests this money in different kind of securities, and these securities generates return over a period of time, 3 साल, 5 साल, and the returns is passed back to you as investors. And for managing this money, the fund manager gets some fees, right? That's what exactly a mutual fund is. I hope you are now able to understand and able to relate to the example of, you know, airplane versus mutual fund. Now many people has this misconception, खासकर last 3 साल में, कि mutual fund मतलब equities, mutual fund मतलब stock market. You know, that's wrong. Mutual fund is like a vehicle. Mutual fund can invest in any asset class, whether it is stocks, bonds, gold, silver, right? Real estate, cryptos, any asset class you think in the world, mutual fund can invest money. Okay. In India, broadly, the investments are done in stocks, bonds, gold, and now silver. These are the 4 asset classes. Still, Indian stock market regulator has not given permission to invest in cryptocurrencies, because you need to take permission from cryptocurrency from regulator. Real estate, regulator has given permission to invest through the form of REITs, real estate investment trust. Through mutual funds, they have not still allowed, but I think in the due course, you will see even through mutual funds, you know, getting into it. So in India, legally mutual fund is established in the form of trust. तो आप जब किसी भी म्यूचुअल फंड में पैसा डाल रहे हो ना, आप वो ट्रस्ट के अंदर पैसा डाल रहे हो, right? So the money is completely safe, and there are hundreds and lakhs of investors who are putting their money into these trust. Okay, the money is invested into various capital market investments, stocks, bonds. मैंने आपको बताया. There are 2 kinds of income that you earn by investing in stocks, bonds, gold. There is a dividend income or interest income, which is a regular income, and there is something called capital appreciation, right? So this is passed back to you as investors. So if you ask me, friends, mutual fund to me is the most suitable investment for the common man. Why I have used the word common man? Imagine, you know, somebody who's a driver, taxi driver, जिसको 500 रुपए महीने डालना है. Somebody, you know, housemaid, gardener. So they can put as low as 500,000 rupees into mutual funds and get professional management. So there are a lot of, so, you know, since a lot of you investors in this webinar have been investing in stocks directly, right? तो आप लोग देखेंगे म्यूचुअल फंड टू मी इज लाइक ए पैकेज आटा. आपको अगर आपको 1 kg राइस या आटा चाहिए, या तो you have your own farmhouse land, agriculture land, you need to be a farmer, you need to have the expertise, you need to have the machineries, right? Crop, seasons, all of this you have to go through the entire cycle. Then you will get good quality atta. Or you don't do any of these, you trust ITC, they have all the mechanism, they are professional, you just go and buy Ashirwad packet of atta, right? To me, mutual fund is like this. या तो हम इतना मेहनत खुद करें, या फिर सीधा जाके आटा खरीद लें, या सीधा जाके प्रोफेशनल फंड मैनेजर को दे दें, and they will manage money. So in India, the structure of mutual fund is like this, very simple. You have a sponsor, somebody has to start the company, okay? And mutual fund, as I told you, it is in the form of a trust. So the trust has to be managed by board of trustees. Now the board of trustees cannot be the sponsor people. Sponsor people are the one who establish the company, but the company has to be governed by trustees, and their job is very critical. And then you have something called custodian, जहाँ पे all the securities which mutual fund invest in is kept there, right? Now, AMC is called asset management company. They are the fund managers to the trust. They are managing the money of the trust. So all the fund managers are hired by the asset management company, right? And finally, you have RTA like Camps and Carvey, who does all the clerical paperwork. आपका statement of account आया कि नहीं आया, आपका dividends, आपका redemption आया कि नहीं आया. This is the legal structure of mutual funds in India. Let me give you an example. Suppose SBI mutual fund है, right? The largest mutual fund in the country, SBI. Who is the sponsor? State Bank of India is the sponsor. उन्होंने start किया था. जो ये trust है SBI mutual fund, it has to be governed by a board of trustees. So the trustee company name is called SBI Mutual Fund Trustee Company Private Limited, and there are 6 or 7 directors in this company. So they are the trustees. कल को कुछ भी mutual fund में होता है, ऊपर नीचे problem होता है, the trustees are answerable because it is their job to question the AMC, SBI Funds Management Private Limited. They are the first level of, they have the first level of responsibility. They can ask any question to SBI Funds Management Private Limited. See, आज हमने लाखों इन्वेस्टर्स ने पैसा डाला है SBI म्यूचुअल फंड में. We can't go every day and ask the fund manager कि आपने ये लिया, ये नहीं लिया, or you violated. That is the role of trustees. Okay, so trustees' job is to ask, oversee that if SBI Fund Management is doing the good job or not. Then they have many custodians. So when they are investing in different shares or securities, they are either parking with HDFC Bank or Citibank or stock holding and so on and so forth, right? So your money is not kept with the AMC. Your securities are kept with another custodian, which means your money is very segregated. आपका पैसा safe है, okay? And finally, you have RTAs who keep all the records. CAMS is the RTA here, right? This is how a structure is there. So mutual funds के many features, you know, I don't have to really go into this. You get a professional management, वो pilot आपको professional मिलता है. You get diversification, right? When you're putting even as low as 500 rupees, you can put your money into 50 different stocks in that fund, right? You have flexibility. आप एक दिन में डालना चाहो, there's no lock-in. You can put 500,000 as a low amount. You can put online, offline, through app. A lot of flexibility is there, right? Accessibility. It is open-ended. मतलब आप जब चाहे पैसा निकाल सकते हो, जब चाहे पैसा डाल सकते हो. At the click of a button, sitting anywhere in the world, you can execute your investments. And finally, safety and transparency. Safety का मतलब ये नहीं कि आपका पैसा नीचे नहीं जा सकता है. Safety का मतलब ये है कि because it is so tightly regulated, you know, it's very less chances of getting any fraud. You know, कि अचानक आपका units गायब हो गए, आपके पैसा आपको आना था वो नहीं आया. That is from that angle. And I must tell you, we are proud that the regulator is doing such a fabulous job. You can sleep peacefully at night as far as any frauds, you know, or this thing is concerned. And transparency is there. You know exactly where your money is going. So these are the advantages and disadvantages of mutual fund. I'm sure आप लोग को पता ही है. You get professional management. You are able to diversify risk. Suppose आपके पास 500 रुपए है. 500 रुपए में तो आप सिंगल स्टॉक भी नहीं खरीद सकते हो. बहुत सारा स्टॉक प्राइस. बट यहाँ पे आप 500 रुपए में पूरा एक पोर्टफोलियो खरीद सकते हो जिसमें 40 स्टॉक्स है. And hence you're able to diversify your risk. Affordability hai, you know, our drivers, you know, can buy. Anybody who has monthly investment of 500,000 rupees can buy. So convenience is there. Now you don't need to sign paperwork. You can do everything. अगर आपके पास मोबाइल फोन है, you can do from anywhere. Liquidity है. जब चाहिए आपको पैसा निकालना, आप निकाल सकते हो. कोई unlike property, जो आपको जब चाहिए आप पैसा नहीं निकाल सकते हो, यहाँ कर सकते हो. Then it's very well regulated. I already told you, SEBI is like 5 steps ahead compared to many other market regulators I've seen, right? They're doing a fabulous job, and that gives confidence to you and me as investors. And finally, because this vehicle is meant for the common people, Government of India gives a lot of tax benefits, right? जो भी म्यूचुअल फंड मैनेजर आपका बाय एंड सेल करते हैं स्टॉक्स को, उस पर कोई कैपिटल गेन नहीं लगता. ओनली व्हेन यू विड्रॉ योर मनी, you know, at the time of your withdrawal, then you have to pay tax. Right? So there are a lot of advantages, but more importantly, you now have to understand the disadvantages. कि disadvantages क्या है? This is, please pay attention to disadvantages because ये generally आपको कोई नहीं बताएगा. You know, सही. सबसे पहला बात है, there is no guarantee in any kind of scheme of mutual fund. You know, whether it is a liquid fund, whether it is an equity fund, nobody can give any guarantee कि आपको ये return आएगा. So since many of you have been investing your money in the last 3-4 years and you might have seen 15, 16, 17% per annum return, there is no guarantee कि ये वापस आएगा. You might lose your money, you might lose your capital because of market movements, So you should be aware of that, right? SEBI doesn't allow anybody to give any kind of guarantees, right? Second, it is expense ratios. Any mutual fund that you invest in has a cost. आप जो plane fly कर रहे हो उसमें भी cost है. There is a pilot का खर्चा, there is fuel expenses and stuff like that. Nothing is free. So even in mutual funds, any scheme that you invest, particularly in equity funds, the cost ranges from 1.5% to 2.5% per annum. Okay, this is the cost that you have to pay the fund managers, the advisor, distributor, whatever. ये cost आपको पता होना चाहिए. And by the way, you can just go online and just type any mutual fund name और आपको उसका cost दिख जाएगा, expense ratio दिख जाएगा. That is the per annum cost. Okay. Transaction cost. So there are many mutual funds where you exit within 1 year or 2 years. You might have to pay a penalty. Just like in fixed deposit, there is a premature penalty. यहाँ पे भी वो penalty है. कई बार क्या होता है, because there is this high diversification, there are 50 stocks, 60 stocks, 70 stocks, it can lead to a lot of dilution, then you will get only the average returns and not, if you want very high returns, you have to have concentrated, but if it is too diversified, then dilution of return happens. And mutual funds are vehicle for common people, so no personalization. आप fund manager को ये नहीं बोल सकते हो कि ये stock खरीदना और ये नहीं खरीदना है and stuff like that, right? So that is what you have to understand. Great. So now, what are the different kinds of mutual funds? Okay, broadly there are 5 varieties of mutual funds. 5 kinds based on asset class, based on how they are structured, based on your goals, based on how each of them is calculated by risk, and there are few specialized mutual funds also. So how do you find out? This one chart would tell you everything about the different types of mutual funds. So based on risk parameters, every mutual fund has to be labeled as whether it is low risk, moderate risk, or high risk, very high. These are the categories. Okay, they need to label every mutual fund based on this. So if you're looking for a very low risk option, you should read that it should mention like it is a low risk, right? Then based on structure, you have open-ended and close-ended. Based on asset class, you have broadly 3: debt mutual funds, hybrid, and equity mutual funds. And within each of them, you have multiple kind of layer of funds. Okay. Then based on objective, you have growth funds, you have income funds, you have retirement funds, you have tax saving, and so on and so forth. And finally, I told you based on speciality, you have index funds, fund of funds, commodity, asset allocation, and stuff like that. So these are the 5 broad asset classes, and we'll go in more detail also, right? But just as to give you an overview picture, this is how it is, right? So we'll take the question at the end, Saugand, so that the flow is maintained, right? Now, you remember I told you based on different asset class, there are 3 types of mutual funds: equity funds, debt fund, hybrid funds. These are the 3 broad diverse asset class. Equity matlab your entire money goes in equities. Fixed debt matlab your entire money goes in bonds. And if the name says hybrid funds, then it's a mix of equity and debt in different proportion. Let me go in more detail. So equity funds means your money is primarily invested in stocks and share of different companies. Debt fund means primarily investment is in fixed income securities like bonds, debentures, government securities, FDs. Nothing is equities here. It's only fixed income. Money market is a kind of debt security, but for short term. Anything less than 365 days investments. Okay, that's called money market. Okay, so which means the safety is very high. It cannot invest in anything which is more than 1 year of maturity. Any bonds, any FD, it has to be less than 1 year. So it is meant for very liquid purpose, right? And then finally, you have last option as the hybrid funds, where you can have a mix of bonds and stocks. You can have a range of mixing from 20% to 80%. 20% equities means this fund is more conservative. 80% equities means this fund is more aggressive, right? So this is how based on asset classes there. Then based on structure, you have open-ended funds, you have closed-ended funds, and you have mixed funds, both, But for all practical purpose, you need to understand 95% of the funds should have open-ended, which means you can invest anytime, you can exit anytime. If it is a close-ended fund, then you can't invest every time, you can't exit anytime. Liquidity is a big thing, right? An interval fund, which means sometimes they remain open-ended, sometimes they remain close-ended. So good example is throughout the year they'll remain closed. Only for 1 week they'll remain open. Who one wants to come or go out, they can do so. Again, next year full year they'll remain closed, and so on and so forth. But as I told you, for you to understand, 95% of our money are going in open-ended funds, which means you can invest anytime and you can withdraw anytime, right? So this is based on structure. Now based on investment goals, पे बहुत simple है. If the fund says this is a growth fund, which means it would invest in shares and anything which is growth oriented. Here the idea is to grow your capital. Here the idea is to capital appreciation. If the fund says it is income fund, then the idea is very simple, that the money is investing in fixed income bonds, where the idea is to get a regular income. The idea is for a short term, 6 months, 1 year, 3 year. Here the idea is not capital appreciation. The idea is to give you regular income. Okay. If the goal is liquid fund, which means here the idea is less than 3 months also, very short term. Rather than money lying in the bank account or in cash, it's better to invest in liquid fund so you can earn a little more. If the goal is tax saving, then there are funds called ELSS, equity linked savings scheme, that give you tax benefit under section 80C up to 1.5 lakh. But guys, remember, it has a lock-in period of 3 years. And then there are different kind of fund. If it says aggressive growth fund, then it is designed to be even more aggressive. It can invest in high risk sectors or countries. If the idea is capital protection funds, here the idea is to protect your initial capital. Okay. But there's no guarantee on returns, guys. The aim is to protect your capital, but the aim is not to give you a guaranteed return like FD. Okay, and so on and so forth. So based on risk, I told you there are very low risk funds, there are low risk, there are medium risk, and there are high risk funds. As you can see, very low risk funds invest into liquid funds and very short term fixed income funds, and very high risk funds would invest in mostly equities and super aggressive equities like small cap वगैरह. Then there are specialized mutual funds. You have dedicated sector funds like IT sector, pharma sector, type of fund. Then there are index funds. So I'll talk about index funds in another slide. Then you have fund of funds. Now this is very interesting. Many people don't know. Rather than choosing which fund is right for you, you can invest in fund of fund, where the fund manager will choose 3 or 4 funds based on what exactly you want. So I'll give you one example. There's a fund by a fund house where they invest in 3 or 4 sectors only, which means IT, pharma, banking, this thing. So the fund manager will choose and pick another fund, based on what they think which sector will do well. So right now, if they think banking is doing well, they will have 30% of their money invested in banking fund. Okay. If they're thinking auto sector is not doing well at all, so they will have either no exposure or very little exposure. That's called fund of funds, right? Then you have international funds. Nowadays, sitting from India, you can invest in any foreign markets like US, Europe, Asia, right? Japan. These are called foreign funds. Okay. Global funds are also foreign funds, but they can include India investment also. Okay. So they can have 25% in India, or they can have 65% in India, 35% globally, right? Then you have real estate funds. In India right now, it is not in the form of mutual funds. You have real estate funds, but through fund of funds, but not direct real estate funds. They are in the form of REITs in India. Then you have commodity focused stock funds. Asset allocation means the fund manager has the liberty to go in and out of from any asset class. If they think equities are doing well right now, they'll put a lot of money in equities and less money in gold or other asset class. That's called asset allocation. So rather than you deciding which allocation is right for you, the fund manager here is taking the call. So these are the different specialized mutual funds. So based on if you're doing investment in equities particularly, right, again, you can further segregate the mutual fund based on large cap, mid cap, small cap. So I'm sure all of you would understand, being MProfit users, what are large cap stocks, what are mid cap, and what are small cap. According to SEBI, the first 100 companies in India based on market cap are called large cap. Then from 101st to 250, they are called mid cap. and from 250 onwards, they are called small cap, right? So if it is a large cap fund, if the fund manager is saying this is a large cap fund, then 80% of the corpus has to be invested in large cap companies. Okay, 20% they can invest anywhere else. If the fund is called this is a mid cap fund, then the fund manager has to invest 65% of the corpus in mid cap. Remaining 35% can go in any category, and same is for small cap. So you have to understand this nuances. Then then there is something called active mutual fund versus passive mutual fund. In passive mutual fund, it is like index fund. I'm sure you would have, all of you would have heard about index fund or ETFs. What is the difference between active and passive? It is very simple. In active, the fund manager creates a portfolio, and the idea is to beat the market. Or what is market? Market is nothing but S&P, Nifty, or BSE, right? BSE 30 stocks or NSE 50 stocks. Now, if you don't need any fund manager, you can simply invest your money in index fund. Okay. If index gives you 15%, you end up almost getting 15%. If index gives you 10%, you end up getting 10%, which means there is no fund manager. You are earning the returns which market is giving you at a very low cost. This is suitable for someone who doesn't have the time and who want just market returns, happy with whatever market is giving, happy. The idea is not to beat the market. The idea is to have worry-free investing. So then I would say passive investing is right. But there are people, there are investors. See guys, many of you might be investing in stocks. Why are you investing in stocks? My question to you, right? You could have simply put your money in index fund, right? Where you don't have to track. But you guys are investing in stocks because the idea is to beat the market. The idea is to try and get returns better than the market, right? So if the idea is to get better than the market, there are two ways. Either you invest stocks on your own, which many of you might be doing, or you give it to an active fund where the fund manager is doing it for you, or you invest in a PMS where again the fund manager is taking the call. So here the reason is that you believe that the market is not efficient, which means there are investment opportunities to benefit from, and you want to capitalize on this, right? So you will choose the companies within the index that are supposed to do well in your opinion, and you will discard. You will not invest in those companies where you feel these companies will not make money. So this is called active versus passive. In US, a lot of people are moving towards passive because it is very difficult to beat the market. In India, I still feel there is a room for active fund managers to outperform after the cost, to still beat. But again, it's your choice, guys. If you don't want to really, if you don't want to really put in a lot of efforts and time, then I think go with index funds. That's the best way for you. For 90% of the people, this is the best way to invest, I would say. Because rather than going in and out from active funds, and lose money there and pay high cost, passive investors would beat 90% of the investors by doing nothing. Okay, this is my experience for the last 20 years. So now with this, giving you a background of mutual funds and the types and benefits and disadvantages, now the main topic is do's and don'ts, that what you should be doing. First of all, guys, you have a diversified portfolio. Now, when I say diversified portfolio, have just 4 to 5 mutual funds are more than enough. Okay, you should have a couple of equity funds, right? 1 or 2 debt funds, like one liquid fund for short term, one bond fund or a fixed income fund for 3-5 years. Maybe you can invest in a gold fund or other thing, but not more than 4 to 5 funds, okay, in a portfolio. I've seen portfolios where there are 20 funds, 30 funds, 50 funds. If you are buying 20 funds, you have bought entire markets and you're duplicating your efforts and you're still paying high cost. इससे अच्छा आप सिर्फ एक index fund में पैसा डाल देते, you would have been fine. Just by putting money in index fund would do all the purpose. Try to keep simplified, don't over diversify. Second, I've seen a lot of people, when they invest money, their only target is returns. 14, 15, 18, 20. That's not a good way to invest. Guys, remember, returns are not in our control. Returns are given by the markets. And markets will not give you the returns that you want. Markets will give you returns that you deserve, right? If few of you would have panicked out in COVID 2020 and pull out the money at the wrong time, you would have been in losses or got low returns, right? So The first rule of investing is you should have a goal in mind, that why are you investing? What is your financial goal? You may want to invest for retirement, education. There are a lot of calculators online, and you should have a plan before investing. So that is the best way to invest. Then you should do your research. Right nowadays, thanks to technology, even I'm sure MProfit would have all those research available for you to find out which scheme has a good track record, what has been their past performance, what is their cost. You can find out everything online. There are websites like Money Control, Value Research. There are many websites where you can see the entire history, track record of the fund manager. So don't blindly invest your money in any fund. Do some research. Okay, that makes a lot of sense. Or ask your advisor or distributor the same information if you are using the service. As I said, cost is very important, particularly when you're investing for 10-20 years. 1-2% cost is very important. So you should be aware what cost you're paying, what is the return that you're getting, and is it worth paying that kind of cost or not, right? So these are the do's of mutual funds. Uh, Rather than investing lump sum, for many of you, I would say SIP is a better way, right? Because you are able to invest at all market levels, right? And if you're doing SIPs, I'm assuming then you're doing for long term, you will stick around for longer time frame. So particularly those people who have a regular income, strongly recommend continue doing your SIPs. Minimum SIP time frame if you're doing an equity fund should be 5 years. Only after 5 years you will start seeing meaningful results. Okay. In my case, I've been doing SIPs for 10, 12, 13 years. My longest SIP, guys, has been for 13 years. And I can tell you, in a tax saving fund where I've been doing, the returns today is around 17-18% compounded per annum for the last 13 years. This is the power of compounding. This is the benefit of investing through long term. And once in a year, you should just review and rebalance. Okay. Not every week, not every month, not every quarterly, either 6 months or once in a year, for 15-20 minutes, half an hour is good enough to see how's your portfolio overall doing. And when I'm saying review and rebalance, it doesn't mean that if you have 5 funds in the portfolio, all 5 will be doing well. Okay. You will always have a mixed bag. Okay. And that doesn't mean that you have to change the fund if the short-term performance is not good. Only after 3 years, 4 years, the fund has not done well, you should understand why it has not done well, and then think of changing, right? I've seen a lot of people today, if the fund is not performing in 6 months, they change the fund. They just keep doing in and out every month, every quarter. I think that's a bad idea, because you will end up paying a lot of taxes and charges, and that's not good. The don'ts. The biggest problem I've seen with most investors is that they just see the immediate past performance and invest their money in mutual funds, which means, like last year, I've seen a lot of money is coming in small cap, mid cap, because the last 3-year returns of small cap is very good. I think that's a very wrong way to invest. You always remember, guys, markets move in cycles. Okay. You have good cycles, you have bad cycles. Every country, every asset class will go through a cycle. So choosing asset class, choosing a fund which has done very well in the recent past, and thinking this performance will be repeated in the future, that is a sure shot of losing money. And unfortunately, I've seen most do-it-yourself investors who are doing on their own without taking any advice, they make these mistakes. Only after 5-7 years, by making a lot of these mistakes, they understand that this is not the way to go. Okay. In fact, on the contrary, I would say any sector that has not performed well, any country, any asset class that has not performed well, if you invest there, there are much more chances that you'll make money when they perform. Right? That has been my mantra. Don't time the market. It is very futile to time the market. If you are there for 10 years, 15 years, 20 years, just, a lot of Charlie Munger says the real money is made in the waiting, not buying and selling. But unfortunately, people think by doing a lot of buying and selling, they can make a lot of money. That's wrong. Don't ignore your risk levels, right? Each of us, who are attending the seminar have different risk levels. There are people who are very happy with 10% returns. They just want to beat fixed deposits. And there are people who are not happy with 20% returns also. Each one of us are wired differently. Don't copy your neighbors or colleagues and think कि मेरे को भी इतना कमाना है. If you're not able to sleep peacefully at night when your portfolio is going down, I think it's not worth taking that kind of risk, right? So you have to discuss, you have to know yourself. That is why I call it KYC. Stock market, if you don't know who you are, stock market is the worst place to find out, right? So that is something that you need to understand. As I told you, I've seen a lot of people who do over diversification. There are people who have 20, 30, 40 funds in the portfolio. It is completely meaningless exercise. You are actually getting much less return than what market is giving you. And you are ending up paying a lot of cost also. And last thing, investing should not be emotional, because the moment you are making your emotions run through investing, you would have panicked in COVID, you know. So markets are all about fear or greed, and we have to be away from fear or greed. We have to try to be rational. We have to maintain balance. So right now, if small caps are doing very well, you should be thinking, it will not continue to do well. It will also go down. You should be prepared. Anything that goes up will go down. Anything that goes down will go up. It is cycle, right? So these are the don'ts. And as I said, anything that you put your money, you have to understand the risk. What are the risks there? So in equity, there are three kinds of risk. You have volatility risk, management risk, liquidity risk. The risk in debt funds, because now today everybody's talking about equity funds, people forgot what are debt funds. But there are also important category. Debt funds has a completely different risk. They have interest rate risk, they have credit risk, and they have inflation risk. So I'll just tell you in briefly what does this mean. See, when you invest in mutual funds, one thing I want to tell you, your money will never permanently go down. The biggest risk in mutual fund is the volatility risk, which means if you today put 1 lakh rupees, after 6 months it can go down to 90,000, it can go 80,000, it can go 70, or it can go 50,000 also. But it will never become zero, because your money, it is not going in one single stock. It is going in 50 different companies, right? And all 50 companies becoming zero is unlikely. The second is management risk, right? Management of the fund manager. Mm, who is managing a fund. If the fund manager changes, if the company has changed completely, that is a big risk. Or if the fund manager has invested your money in certain companies and there the management has changed, that is a big risk, right? So finally, this whole thing is about people. We are dealing in a people business. So that is why the management risk is very important. And finally, liquidity risk. Imagine if in COVID markets was shut or markets was down and you want to exit, right? Particularly in small caps, they may not be as high liquid as large cap stocks, right? So if they're not as liquid, you might have to pay premium or you might have to pay cost to exit. So these are the three risks. But if you ask me, guys, I would say 90% of the risk is volatility risk. And that is what is unnerving, uncomfortable to people. In debt funds, the three main risks are interest rate risk, interest rate going up or down. So if interest rates is going up, particularly after you have invested, your portfolio will go down. Okay, and you can never predict perfectly where interest rates are going. But I'm not worried about interest rate risk, guys. I'm more worried about credit risk. Credit risk is risk, if your mutual fund manager has invested in those companies and the underlying companies where they've given loans, those companies are not able to pay back. It is a default on the loan. That is called credit risk. Okay, so that is called a permanent risk, which means if the company is defaulted, then it's very unlikely that you'll get back your capital. So you should be really worried about credit risk more than the interest rate risk. Okay, and finally you have inflation risk. If you're investing in funds where there is no credit risk, no interest rate risk, and it is only giving you 5%, right, return, but the inflation itself in our country is 7%, then you're running a risk called inflation risk. Your money is not able to beat inflation in the first place, right? So all three you have to understand well. This is the suitability metrics. If your time frame is 6 to 12 months, and if you're a low risk profile, you should be on the lower left end of the curve. And on the contrary, if you have more than 7 years, 10 years, and if you're an aggressive investor who doesn't mind volatility in the short term, then most of your money can be in mid cap and small cap funds, right? So this is how you have to understand. Each person is different, and this thing there. Okay. Now, there are some 10, 15 different kind of debt funds in our country, and there are 10 different kind of equity funds also. Each one has their different risk reward mechanism. And this chart tells you which is the lowest risk fund, which is the highest risk. So in debt funds, the overnight fund has the least risk, right? But what is the risk you are facing here? The inflation risk. In long duration funds, you have very high interest rate risk, or you may have high credit risk also. Okay, so this is more risk, more returns. Same in equity funds. The large cap companies like HDFC Bank, ICICI Bank, these are the large cap companies. There, the risk is lower compared to sector funds or thematic funds or small cap funds. There, the risk is high. So I always tell people, first 0 to 3, your money is into fixed income, bonds, or whatever. Here, you can expect around 6 to 8% kind of return. Money is not invested in equities. Now, when you're investing in 4 and 5, you have some amount of equities. That's why it's called balance or hybrid. It can be 20%, 30%, 50%, 70% also. Okay, it's a mix of equity and bond. Here, you can expect maybe 9, 10, 11% kind of return. But the moment you have started investing in 6, 7, 8, 9, 10, you are going into pure equities, pure equity funds. Here, the risk is very high and the volatility risk is very high here. And you can expect around 11, 12% to 14, 15%, 16% return over a long term. So when you are investing in 6 to 10, your time frame should be minimum 5, 7, 8 years. Okay. So low risk, low time frame, high risk, high time frame. And every mutual fund will have this kind of label, whether it will tell you whether this fund is a moderately high risk, low risk. You should be aware that the money that you're putting in which category it is going, and based on the risk that you're taking, you can expect what kind of return you should have. So if you're going towards equities, it will be very high risk. If you're going more towards debt fund, it will be very low risk. So with this, as I told you, my 45 minutes I have completed. And Andrew, would you like to just share the audience about the benefits of this also?
So thank you, sir. Thank you for the insightful session on mutual fund do's and don'ts. So, team, we have three exciting gifts, right? It's a takeaway which is completely customized for all the participants of this financial well-being programs, right? So we conducted everywhere, and as a post-session activity, right? So whatever theoretical you have went through, but practically you need to assist yourself and keep yourself updated, right? Use all the tools which has been there in the market so that you keep up your financial well-being in a right manner, right? So the first gift would be uh, so it's 31 action email, right? So next slide please.
Yeah.
Yeah, so 31 action email, right? So people can subscribe for this 31 action email, and this is gonna act as a to-do list for you, right? This is gonna prompt out or ask you questions that have you done this, right? For example, have you added your nominee details? Have you maintained your documents or organized all your informations within your family, right? And about your insurance, about your investments, and also the timely market updates, right? These are not going to spam you, right? We don't have a product over here to sell you anything, right? And this is not a promotional platform which we do, right? So you can subscribe to the first gift, it will be very useful. The second one would be, we have few sophisticated tools. These are Excel tool, but formatted by the financial planners of India, right? We pulled in so many people. We used our intelligence to build such tools for you to make use of it. The first tool would be the financial statement builder, right? Which acts like a budgeting tool where you track your income and expenses. And the second one would be a FIDOC, family FIDOC, where you can add all your family details or your investment details and your nominees, your policy details, your investment e-cash detail, everything. Put it and you can keep it updated with your family members, so that something happens to us, the family would be able to access these documents, right? The last one would be financial goal metrics for you to prioritize your goal, right? Until and unless you don't know what is your goal, there's no point in investing, right? So you need to have a goal, so this tool will help you to prioritize your goal. And we will also be sending a tax calculator tool along with this, wherein you just try to put your salary and it splits out the whole taxes into new regime and old regime, so that you can select your tax and you can file in your taxes. And the last would be a very exciting gifts, right? So we as a community, we provide you the option for getting in touch with the financial planners across India, right? So you people are already investing, but still you have any questions, be it stupid question or it can be a serious question, you can get in touch with these people, right? So our financial planners will help you to give you around 30 minutes of free consultation in an ethical way, not a sale call, right? A complete query solving or a expertise call you can expect. So that this is going to be a free because you participated in this well-being, and so that's how you will be able to get these three gifts. So the last slide will have a QR code, right? So team, I would recommend or I would request you to scan the code and give your valuable feedback for the session, like what you learned in this session, and also avail the free gifts, right? And yeah, over to you, sir. You can drop in the questions in the chat box, and we will be able to answer all your questions. We still have time, right? And please do give your feedback. Your feedback matters to us, and also let us know. So how can we get these tools? So once you scan and give your details, your personal email ID, we will be able to share these tools in the email, which is a complete downloadable format, right? So drop in your questions in the chat box, and we will be able to take up the questions. And I see that we have 74 employees. We need each and everybody's feedback over here, because this is going to help us to fine tune the content more and more for the future sessions. Any email where I can send request for tools? Yeah, you can share it, but this is an
In fact,
automated one.
yeah, in fact,
You'll be
you scan this QR code, and you will get tools. The moment you put in your email ID, Network FP will send you all the tools. And if you have any further queries, they'll be more than happy to revert to you on how to use it or whatever. And if you want, they can help you schedule your call with some advisor who can also guide you on how to use these tools if you're getting stuck. Right? And
Yeah, for example, if you want to get in touch with Mr. Gajendra, then it is easy. Like you click on the link and you get to Gajendra's profile, and then you have a call with him. Team, I'm also sharing a link, the same version of the QR code, so that it helps you.
yeah, you can just click on the link, fill your details, and you will get all these things. I would strongly recommend to do this because the best thing about these tools I like, there is a 31 action day. Every day, you'll just receive one email on some important action that you need to do with your finance. And this is, guys, believe me, this is so simple and so effective. If you're able to follow these 31 days, I think your 95% financial life will be very well organized. And this has nothing to do with marketing of any product. This just talks about concepts, that are you good with the concepts or not, kind of thing. And today's session, the idea was to try and, familiarize you with the do's and don'ts. And based on my last 20 years of experience, of course, there are many things you can't cover in 45 minutes time. And that is why I'm now open to Q&A. So let me just start with the question that first came in the chat, box. So I think there was a question which said, Mr. Sogan PR asked a question, how and when is the expense ratio deducted? So suppose if an equity fund has an expense ratio of 2%, right, Mr. Sogan, it is deducted it is calculated every day. Okay, 2% divided by 1 day, 2 day, 3 day, and it is reflected in the NAV. So the NAV that you see in the morning every day, 2% for that particular day has been debited, and the fund manager takes the fees on a monthly basis and even pay the distributor on a monthly basis. So that 2% is not directed on one particular day, ki saal ke end mein or saal ke first beginning mein. It is apportioned throughout the year, and that is why you are not able to see the big difference, right? Because it's through the year, right? So, but in all the websites, you can find what is the expense issue that is being charged. And it is per annum, guys. It's not one time. Every year on the current value of your investments, whether it is 1.5, 2%, whatever you can see there, and it is directed. Which means if you make a lot of money in the process, your fund manager and your advisor is also making money. So it's like a win-win situation, in that sense. Sumit Bansal says, I have a decent portfolio in mutual fund and the time frame is long term. investing for wealth creation. Can I do a 30-40% monthly sip in small cap? Now, Sumit, if you're an experienced investor, you've been there into the markets for 4-5 years. And as you rightly said, you have a very long term. When I say long term, I mean 8-10 years, particularly for small caps. Okay. Nothing, guys, I invested my money in a mid cap fund. In COVID time, my 4 years SIP in a mid cap fund was minus 19%. If you can take volatility risk in your side and can have a long-term patience, then you can have 30% or 40% money in small cap. Right now, almost all investors are putting money in small cap because last 1-2 year return have been good. That's a big risk. When the cycle turns other way around, I will see a lot of SIPs in small cap funds, a lot of people withdrawing money in small cap funds. That is a time, if you do not panic, then you are suited for long-term investments, right? Ashutosh had a question: what is the purpose of the custodian? See, SEBI wanted to make it so diversified, which means nobody should have the entire control. If tomorrow the fund manager has all the money, the fund manager has all the securities. You remember what happened in Carvi episode? Because Carvi had all the control of your shares, right? They used your shares and they pledge it for some other purpose. So SEBI wants it to be diversified. Your shares should be with dedicated custodians who are registered. Your bank money should be in the dedicated bank accounts, so that fund manager has no control. The role of fund manager is to just manage your money. So if they have to buy or sell something, they have to instruct custodian, buy this for me or sell this for me. So there are Chinese walls between everywhere, and that means our money is safe, right? If there are 40 people involved, 40 different entities are involved, then no one person can do any of fraud, right? So that is why we have different fund houses, custodians. Okay. Request copy of presentation, that I will leave it to MProfit or Network FP if they want to give the copy of the presentation to the participants. Anand P. So I'll take some questions from the Q&A box also. Roshan Kumar said, should investors hedge their portfolio also through selling long dated call options? Roshan, this is a too technical question for me. I have all my money in mutual funds. I've not been a big fan of F&O myself. I've lost money in F&O, long back. So all my money are mutual funds. So I'm not the right person to answer this question. Will you throw some light on alpha? Shashikant Magani has a question. Yes. See, alpha is anything that you are able to generate over the market. Okay. There are fund manager, all the active funds. When you invest in active funds, the idea is to generate alpha, right? But it's not that simple. The research shows that 60-70% of the people are not able to generate alpha, which means after the cost, they're not able to beat the market. So my question is, for 80% of the investors in India and elsewhere, and all the more if they're doing on their own, if they're investing on their own without the help of an advisor or a distributor, then my strong recommendation is go into index funds. Otherwise, for the fight of alpha, for the search of alpha, you will actually end up losing beta also, which means you will end up giving market returns also, right? Because I've seen a lot of people do in and out. 6 महीना small cap में डाला, 6 महीना mid cap में डाला, sector fund में डाला, international fund में डाला, and they come in at the wrong time, they exit at the wrong time, and they even give the beta. Forget alpha, they give the beta also. Satya Prasad had a question: what are the parameters to be checked in selecting a mutual funds? Very good question, Satya Prasad. The first answer is, what are your goals? Why you are investing in the first place? How long is your time frame? What kind of returns you are expecting? You have to be very honest. Are you happy with 10 to 12% returns? Are you a person who wants 15% returns? Remember, the more returns you want, the more risk or the more volatile it will be, right? Right? These are first factors. Then secondly, when you're selecting a mutual fund scheme, check who is the fund manager, how long that person has been managing funds, what is his experience, what has been his long-term track record, right? What kind of portfolio he has, what is his philosophy. See, the first thing is to understand the philosophy of the fund manager, and is that fund following the philosophy that they have laid out, right? So once you have done all of this, then go and put a fund. We generally recommend not to put in a new fund. If a new fund is coming in the market, we generally don't recommend, right? You should know the track record. Mohammed has a question: difference between small case and mutual fund, and which one will work in long term, considering in terms of expense ratios, etc. Mohammed, I am a big fan of mutual funds. For two reasons. I'm a all my money is in mutual funds first, and I'm also an advisor distributor, so I might be biased there. But I've seen that mutual fund is a retail vehicle, and that is why SEBI as a regulator, when they are regulating it very tightly, I get more confidence. Okay, so I would say mutual fund is far more effective for 95% of the investors. Those of you who are looking for very specialized kind of vehicles, may look at small cases kind of thing, but expense ratios and everything is so tightly managed in mutual fund. I would be more comfortable in putting my own money in mutual funds, and this would be my opinion. Kiran Ben has a question: SIP of mutual fund or direct purchase of shares in SIP, monthly or particular shares, better out of the two? Again, Kiran Ben, if you have the time and the knowledge to know which share will do good in the long term, then you can put your money into stocks directly, SIPs. If you don't have time or the knowledge or the bandwidth, I would say stick to mutual funds, right? You should be very clear. Just to save cost, of course, mutual fund has cost, right? Just to save cost, if you think you can beat the fund manager who has 20 years of experience, I've not seen many people doing it. Very few people I've seen in my life who in the long term has beaten the index fund or the market and the fund managers and have generated. Very few fund managers. Paresh has a question: does with the new tax regime investing in ELSS funds with 3 years lock-in make sense? Yes, I agree. If you are going for the new tax regime where you are not getting any benefit from ELSS fund, then you should not put money in ELSS fund because you are unnecessarily locking your money for 3 years. You have normal other funds where you have no exit load, entry load, and there's no lock-in. You can kind of use those funds. It is only meant for those people who want to get tax benefits who are in the earlier regime. Then this is making sense. Then Ananda P has a question. Let's say we invest for some 5 years and realize fund is not performing as market index. Then what do you look at other funds to choose to shift? Very difficult question, Mr. Ananda P. 5 years is a good time frame. If the fund manager has not performed well, maybe it's time to do some more research and introspection why the fund has not performed, or what has been the reason. I'm sure you'll get a lot of articles which will tell you about this. If the fund manager has been great, has had a great track record over a very long term, but last 3-5 years have not worked, maybe you can still give some more time, because sometimes 5 years also not good enough. But otherwise you should find better performing fund or a better fund manager within the same category, right? But again, there are no straight answers, Ananda P. A person like me, I'm sorry, I'm telling you very upfront and honest, a person like me doesn't put much emphasis on individual funds. For me, asset allocation, like which sectors, small cap, mid cap, these are bigger questions. Within a small cap fund, I'm not too fussy that whether it is A fund or B fund. I don't really care much, and I don't think that really matters much within that given category. So for me, category returns, whether you are in equities at the right time, like in COVID, whether you've chosen A equity fund or B fund didn't matter as long as you had put your money in equities as an asset class, right? So in COVID, I put substantial of my money in March 2020 in small cap funds, right? So whether you're putting in Kotak or Axis or ICICI, it doesn't matter because small cap as a category did very well, right? So I always believe in that. I'm okay with underperformance for 3-5 years, quite okay. Where will this recording of this webinar available? Again, you'll have to ask Abhinav, the host, as in MProfit or Network AP. Please explain direct versus regular investment. Ganesh, good question. Direct investments are those where you are not using the help of an advisor. You are investing your money into the mutual fund directly and you save some good cost, right? Regular investment is where you are taking the help of an advisor or distributor particularly. Indirect, you can take the help of an advisor and you pay the fees to the advisor directly, okay? Direct doesn't mean cheap. Direct, it means just that your money is going in direct plan. You can still take the help of a registered investment advisor and they will charge you fees and you can take the expertise. When you're investing in regular, the mutual fund distributor earns commissions from the fund, okay, which you can see exactly how much they are earning and it is debited from their portfolio. So which means, guys, if you're able to do your research on your own, if you're able to manage your own portfolio, you don't need an advisor, then you can invest in direct plans. But if you think that you don't have time or the knowledge, and to say that 0.5% or 1%, I think in the longer term, you'll pay a much higher price for the mistakes that you might have made on your own. Sanjay S has a question. Good session on MF. Thank you so much, Sanjay ji. One question: if PMS equity gives high return, or is it invest to better? Sanjay ji, again, I have a little different view, and I'm giving you my honest opinion. I'm not a big believer of PMS compared to mutual funds for two reasons. The cost in PMSs are high, and the taxation is not very favorable. Okay, mutual fund is far more tightly regulated, which means they are more under scrutiny compared to PMSs. So I would give 90% of my thumbs up to MF compared to PMS. Having said that, I have my money in a couple of PMS schemes also. 90% of my money is in mutual funds, 10% of my money is in PMS. But after 10 years, I've realized that they don't have really much edge. I think mutual funds are good enough. You can use the link. What are the benchmarks should one check before selecting a fund? You have to it depends. If you're choosing a small cap fund, you have to choose the small cap Nifty benchmark, right? Then Nifty 50 is not the right benchmark. If you're choosing a IT fund to invest or a pharma fund, you have to choose the respective benchmark if the fund manager has beaten that benchmark or not, right? So, and that is mentioned, with every scheme, which is the benchmark they are comparing the returns. So guys, if you've not given your valuable feedback, please give your valuable feedback. It's very important for us to, to organize the sessions and take the benefits of the gifts which Network FP and MProfit is giving to you. Thank you so much for your feedback. So please leave your feedback. I hope, you enjoyed the session. Whatever questions which have been listed here, I've been able to answer the questions. If you still have questions left, guys, please send it to Network FP or MProfit, and they would send it to me, and I would like to answer them. But last but not the least, please leave your feedback and please subscribe to these free action items. I think Kiran Ben Bhavsar, you have raised your fingers. Would you want to type this thing? I think two people have raised hands. So do you want to type in your question or feedback on the chat box? Okay, Q&A. Okay, there are a few Q&A. Sorry. How to handle the scenarios when there is either management change at AMC level or fund manager change? Good question, Paresh. I feel generally I don't give much importance to these unless there is a very significant change. I don't give much changes. Like last year, Prashant Jain left HDFC, but HDFC is a very reputed fund house and they have a lot of good talent. So it doesn't mean that if Prashant Jain has left, now it's time for you to change the fund, right? I'm not a big believer of this. I believe the other fund managers are also doing a great job, and you have to give time, 2-3 years, to see before you take those decisions, right? So again, Paresh, I'm a big believer of asset allocation and the category selection more than fund selection. I don't really spend much time there. Can we identify this impact and take necessary action in an early stage? Not really worth it. I don't think anybody can identify whether the new fund manager is a good fund manager or not so good fund manager. Only in hindsight you'll be able to know. Please, allocation of mutual fund investment with the age. Kiran Ben, this is very difficult. Warren Buffett at age 93, all his money is in equities, right? So it has nothing to do with age. It all depends on, are you able to sleep peacefully at night or not, right? If you're 25 and you're not able to sleep peacefully at night, put less money in equities, is my suggestion. Paresh, you have another question. Can we have a SIP option even for ETF? Yes, you can have a SIP option even for ETF. You have to ask your stockbroker, because ETFs are invested in demat accounts. So your stockbroker would allow you to invest in an SIP manner also in ETFs. So I hope I have answered all the questions which were there in this thing. Let me see if there are any more questions in the chat box. Right. So please, so MProfit has mentioned, please refer to their blogs to help various other products. They also mentioned that this webinar will be recorded, and early next week on the MProfit YouTube channel. So you can again watch it, or you can share it with your friends or family if you liked it. With that, if there are no more questions, Andrew, shall we call it a day?
Yes, sir. Over to Anjani.
Yeah, thank you so much, everyone, for your valuable time. And I hope this session was helpful. And thank you so much, Gajendra, Andrew, Network FP Team. I think the series should help investors and plan their journeys better. So please do share your feedback, and you can follow us on our YouTube channel where we keep sharing our webinar videos, and the upcoming session would be uploaded very soon. So you can see it there. You can read our blog section. You can follow us on our social media channels. We try to share informative information that can help you invest in your journey. And any feedback from your end regarding to MProfit, the webinar series, is really welcome. Thank you, everyone.
Thank you, Anjani. Thank you, MProfit and Network FP for doing this initiative. I think this is a very, very, a progressive step to educate our investors. And I'm sure as a community, if they benefit, I think, then we're all on the path to financial independence. Thank you once again.